Hi everyone, hope you're all doing well, and today I'm going to talk about the two stocks that I bought that crashed after their earnings, and I'm also going to talk about one stock that I sold. I didn't sell all my shares, but I did sell a good chunk of them. The reason why, I'll save it until I get onto it, but I'll go through the reasons why I did that last week. So yeah, these are the two stocks that I bought. These reported earnings last week and crashed a huge amount, and I thought, let's pick up some shares in them. Just before I get onto it though, if you do want to know when I'm buying and selling companies in real time, make sure to join the Patreon, link is in the description. I also post 2 exclusive videos a week on there. One of them has just gone up, which is my UK portfolio review for February 2022. So go check that one out if you do want to know that sort of stuff. And if you want to start investing, there's some links to some brokers in the description as well, like free trade. Join through there, you get a free share as well. But we'll get stuck onto these two stocks that I bought and one that I did sell some shares of. So the first one, Facebook. I did buy some shares in Facebook. I did not buy a huge amount. This was a very tricky one for me because I did look at Facebook, and it's a stock that I've held for around about 4 years now, believe it or not. I think the first time I ever bought Facebook was around about 2018. So we are going on to nearly 4 years of me buying this stock. This is one, it's a really tricky one because I love Facebook and I always wanted to make it a big position. It used to be one of my biggest positions. It's not as much now, but I still have quite a few shares in it. And I always said if Facebook was ever to have a crazy drop, it dropped down to $280, I would really love to buy loads of shares in it. And it's even gone lower than $280. We're down at $228 right now. So this is even way lower than what I was hoping for it to go to. And always with everything, the only reason you're ever going to get a dip is because something negative comes out. And you've always got to understand that, you've always got to look at the dip and what is that news that has affected the company. And do you look at that dip and go, is this an overreaction? When you look at the long term, 1 year, 2 year, 3 year, even longer than that down the line, is this a problem that's going to continue affecting Facebook? And in the long term, will its revenue still do well? Will the profits still do well? And if that's still the case, then normally these dips are overreactions and you buy them. And I thought, with Facebook, hopefully that happens. I buy up that dip, and we do okay from here. Now the problem is the dip has come from Facebook, and the problem is that the news that caused the dip was actually a little bit concerning. Like, I looked at the dip on Facebook and thought, okay, hopefully this is an overreaction. But for me, I did look at it and go, okay, there is a few red flags here. So I did buy this dip in Facebook, but probably not as much as what I was hoping to, because I just had to be a little bit cautious that this dip is caused by a few problems, and I have to make sure them few problems kind of disappear before I commit too much more into Facebook. So I did buy, but I didn't buy as much as I thought I would if I had this much of a dip in Facebook. So that's something to say about that risk of this dip right now. But yeah, so much has been absolutely, chalked off that share price. This was a stock, if I go from when I first bought it in like 2018, which was like the Cambridge Analytica, it was a stock that was up, over 100% on, well performing stock, and then boom, even now it's not up that, it's still up a bit, but still not amazing for a 4 year period time frame. 130+% or whatever it is over a course of 3 years is pretty good going, but just like that, boom, it's lost so much value in it. I think this was like a $1 trillion market cap, and now it's down at 620 billion. The P ratio is 16. Now this is probably the key point to make. I'm probably going to make this a little bit more detailed later on. Is that Facebook at the moment? You've always got to remember that Facebook has never been trading at ridiculous valuations. This isn't a company that's trading at like 60 times earnings. This is trading at 16 times earnings. And this company, when you look at this, you would think at 16 times earnings, that's generally like your normal average value stock that grows, maybe 3% a year, pays a bit of a dividend. That's what you're normally looking at that sort of valuation, which is very important, because when we talk about this a little bit later on, and we talk about the growth potential of this one, this is why you've always got to think about this, is that you've always got to look at this valuation and go, at the moment it's priced as a value stock, not a growth stock, which is important, which we're going to talk about in a second. But yeah, that's it on Facebook from that point of view. Now, getting on to the actual earnings and what caused the drop in earnings. So EPS was a bit of a miss and the revenue beat. Now, the revenue itself was good, 20% year over year growth. Once again, if we go back to the valuation, 16 times earnings, you normally don't get companies that grow 20% at 16 times earnings. So that's obviously really impressive. This is why I've always liked Facebook. They've always been able to ramp up the advertising grow at very good rates, have very good profitability, good balance sheet, and you're picking all that up for 16 times earnings, which is obviously fantastic, and that's why I've liked it. But this isn't the problem why the share price dropped. This is what caused the share price drop. So there was a little bit about daily active users. For me, I don't worry about daily active users Facebook. They, the amount of users they have on there and the scale they have to advertise and use them users, even, at some point, because Facebook, or Meta, should I say, gotta start saying Meta really. The thing with Meta is that they have so many users now that at some point it is going to slow down. They have so much control of users now. Rather than looking at negative, okay, it might decline a little bit, it might flatline for a little bit. You've got to think about the potential that they have. Like, I can't even remember what it is now. What is it? 3.5 billion users to use. Not even just from an advertising point of view, just to have that control. If Facebook wanted to launch a new service and all that, they have access to put this new service to like 3.5 billion users, which is unbelievable. And I think that's more powerful than monthly active users moving up 1 or 2% every kind of quarter. The amount of control they have now is unbelievable. The amount of access to users they have is great. Now, this is where the problem came in for Facebook. So it was the guidance. So the guidance was way below estimates. So there was no long-term guidance given because of the uncertainty out here, which is very important to say. But the short-term guidance that we got was in the first quarter of 2022, total revenue is to be in the range of 27 to 29 billion, which represents 3 to 11% year-over-year growth versus 30 billion. So there's a massive drop off on the revenue guidance here, which is the problem. Obviously, that's also going to affect the profit as well. So when I am talking about 16 P ratios, you've got to take that with a little bit of pinch of salt as well, because there's so many different things that could line up here. So obviously that's a massive difference of guidance here. 3% to 11% is totally different. But the thing is as well is like everyone in Facebook was expecting this company to grow like 15 to 20%. So you've gone from a company that was expecting to grow 15 to 20% down to 3 to 11%. So that's a massive drop off. And obviously that's also going to affect the profit side of it as well. So that's obviously going to affect the share price. So there's a lot of uncertainty here. That's a massive range. Now the big thing is that without doubt, if Facebook, in the long term, Facebook could recover and go back to, 15, 20% revenue growth. If it does that, this valuation is absolutely cheap, absolutely cheap, and you want to be loading the boat. The problem is we don't know if that's going to happen. And the other thing is the guidance that was given here. If this does turn out to be a year where Facebook grows 3% through the full year, that's going to be a massive problem. If it grows at 11%, at the moment, it's not too bad. But this is a big thing. There's just so much uncertainty now because people don't know what the rates and what that will lead to the profit will mean for Facebook in long term. This is the big thing. You're looking at this valuation here and thinking, okay, if this company continues to grow at, probably even 10%, 15, 20%, and it's at this valuation here, this is a really good purchase. But the problem is Facebook turn around and for the rest of the year they grow at 3%. That's going to cause problems. Facebook will have a very ugly 2022 if it struggles to grow. And that's the big uncertainty here. And this is why I haven't fully bought loads on this dip, which I thought I would do, is because I've got to accept that if Facebook has a really poor year and grows at single digit percentage rates and it was expected to grow 20% rate, that's not going to do well for the stock. And I have to be open about that. So that's the only concern that I have. I thought I'd buy the dip, see where we go from here, wait for another quarter, see what update we get, see where we come in on numbers wise in Q1. But that's the thing. It's so much uncertainty. But what you've got to look at as Facebook is not just what's happened in this one quarter. What has Facebook done historically? Facebook has a very good track history of delivering. So at the moment, I have the valuation it's at. Even if it does grow, 10%, 15%, 20%, if it grows at them sort of rates and it's at this sort of valuation and it's got its track history, I'm going to bet on Facebook doing well here, and that's why I bought it. But the whole reason why I haven't gone too crazy into it, tunnel vision in, is because I have to be cautious about it and make sure I get some more updated numbers just to make sure, okay, Facebook, it was kind of a one-off situation here. It's going to go back to being a, profit revenue growth beast going forward. So that's what I've got to be careful of. It's also worth saying that one little concern that I do have as well with Meta is they are spending a lot on the metaverse at the moment. That's the $1 million question. If the metaverse is successful, Facebook's going to be laughing for the next 10, 20 years. It's going to be once again one of the best performing, best stocks to own in the stock market. The other thing you got to look at is if Metaverse doesn't work out for it and it flops, they've spent so many billions on it, and that's going to really sting the company as well. So at the moment, I've also got to be careful because Facebook are doing a big bet in that area, and that's probably going to dictate how well the company does over the next few years, and that's something that I am kind of considering. But just on the valuation point of view here, I mean, look at the metrics. Enterprise to revenues is a 4. I mean, it's never been a 4 in the last kind of 4 years. EBITDA is down at a 9.6. It hasn't been there since 2018 in the correction. If we go on normalized P earnings, it's a 17. Same again, it hasn't been down there since. It's even lower, but it hasn't been that low since the 2018 stock market correction. So yeah, like I said, a lot of these metrics are standing out as being quite cheap at the moment for Facebook. But like I said, there's uncertainty about what numbers they are going to come out with in the long term, and depending on what happens, then you've also got to take some of these metrics and the valuation with a bit of pinch of salt, because if they start growing at 3%, then obviously you've got to discount all this. But if they go back to being quite a good beast on growing profit and revenue, then obviously it is a cheap stock. So yeah, I thought I'd just buy and see what happens there and wait until I get a bit more data before committing too much. But I thought I would capitalise a little bit on that dip. So the second stock that I bought, well, first of all, I'll talk about the stock that I sold. So I sold a little bit of Visa. If you don't know, I do own Visa in my Giro account and my Trading 212 account. I sold off my Trading 212 shares for a little bit of profit. I still got my Giro ones, but the reason why I sold off my shares in Visa for a little bit of profit is because I saw a better opportunity out there. The better opportunity was to go buy PayPal after earnings, and after earnings, PayPal crashed, and I thought I'd buy this up, and I think PayPal at these valuations is a better company than Visa. So I am kind of considering selling all my Visa and putting it into PayPal, something that I'm still thinking of at the moment and not decided. But I do currently own Square, Visa and PayPal, which I do think to have free payment companies is a little bit much, and that's why I'm also considering getting rid of Visa and putting that into PayPal. So that's something that I am kind of considering at the moment, not fully decided on, but I am thinking about. But I thought to start a new position, and as well as that, I'm a little bit limited on cash because I've been buying quite a few stocks at the moment because so many are down. To build a new position, I didn't really have the cash to kind of build that up. So the only way to kind of buy PayPal on this dip was to kind of release some cash from another stock, which Visa just kind of made sense. So yeah, I did. So I still own Visa, but I did sell a good chunk of my Visa position off to put that into PayPal. And at the moment, PayPal now stands out to me to be a good valuation now. I've been watching this since 180. I thought, okay, it's not too bad. I thought if it gets to 150, I'll buy it 150, and then earnings took it way past 150. That I was like, okay, I'll buy some more shares in this one. Yeah, and I think, you look at the trend, PayPal's one of those stocks that has historically just grown revenue, profit, and it's a stock that kind of brings in those nice 20-30% gains a year. I mean, you've got 71% there. Here you've got 2018 around about 5%, 2019 to 2020 you got about 31%. So this is a stock that will, depending on how the stock market goes, will over an average period of time, I'd say probably bring in around 20-30% returns. Obviously 2020 to 2021, the stock went up to crazy valuations. Without doubt, it was massively overvalued at these sort of prices at $308. 52k of $310, but now it's down at $119. I think this is quite a good opportunity. You look at pre-CV, it was 118 there, around there. You got about $122. So you are back at pre-CV prices, and when you look at this company over the last 2 years, sure, it did get stretched to overvaluations, but still in that time, in the last 2 years, I mean, if I can just flick to the past performance, look at here. The revenue pre-CV was 17 billion. Now they're doing 25 billion. You look here, the profit was 2.4 billion. It's now 4.1 billion. So you look at this here and think, okay, it's the same price as it was 2 years ago, and you look at the progress of the company and you're like, okay, that's kind of crazy. Down at 33 times earnings. And yeah, from 52 highs, it's down 59%. And I look at this one now thinking, this for me is one of those stocks that you look at the share price drop and go, yep, it needed a pullback to fair valuation. But then it's had its pullback to fair valuation and it's gone, boom, now it's gone undervalued. You know, it's ridiculously undervalued. It's overreaction now. And that's what I'm looking at with PayPal. I believe that PayPal has now had a massive overreaction and I'm happy to buy shares in this one right now. Now, once again, dropped off earnings like Facebook. Numbers weren't bad at all. This is the thing. Facebook, I understand why it dropped so much. PayPal, I looked at it and thought, yeah, it deserves to probably drop a 5% maybe. And then how much it did drop, I was like, wow, that's crazy. You know, if we look here, there was a little bit of miss. So it missed slightly by 1 cent, but the revenue was a beat. So from the earnings point of view, fine numbers. It dropped off the outlook. That's a big thing. Like Facebook, it had an outlook drop. So revenue expected to grow 15 to 17%, which is still fantastic. You know, and the company's still moving in the right direction. 15 to 17% is still massively impressive. But the only problem is that we were expecting 18 to 19% revenue growth. So revenue growth was only, you know, decreased slightly. It's still going in the massive direction. And like I said, I thought that was a massive, you know, just to be a little bit slower on the revenue growth and to have that drop was crazy to me. And excluding eBay, revenue to still grow 19 to 21%. So one big thing they have at the moment is they are moving away from eBay. That's happening a lot faster than what they thought they would. And that's what one of the big effects on like the revenue slowdown is. But after the end of this year, that will kind of go away from the company. And if you take away that from the company, it's expected to grow 19 to 21%, which is still fantastic. And same again, the EPS had a bit of a drop off. So non-GAAP EPS expected to be in the range of 460 to 475, and the consensus was 526. So yeah, obviously there's about a 10% drop off in there in that EPS range, which same again, obviously I'm fully open. I expect that to obviously affect the share price slightly. But once again, I look at this and going, to put it down at these levels, you know, to have that drop off, it's not that big of a deal. You know, it's still all moving in the right direction. And sure, it's not great, but to lose what PayPal did, if I can look here, I think PayPal's earnings was somewhere around maybe this time, you know, in the last kind of month. You know, 36% down. It's like, it's just crazy. It's crazy, I thought. So yeah, I thought the guidance obviously wasn't what you would hope, but that's what caused the drop. And now I look at that drop and going, is this an overreaction where I can buy? And I thought that was. I listened to the earnings call. I was impressed with the earnings call. I had some quick highlighted points here for you. So in the Q4, ex eBay, our revenue was very strong, growing at 29% on a spot basis for the full year and 22% in Q4. Fantastic. Obviously, when them eBay concerns go out, this is going to be good. So this is a little bit of a paragraph on the conference call about eBay. 2022 is going to be a year of transformation and investment as we transition from outsized growth driven by lockdowns during the pandemic and finalize the lapping of eBay's managed payments transition. eBay's transition will put an incremental 600 million of pressure on our top line, approximately 400 million in Q1 and 200 million in Q2. So you can see that as we go on, that should drop off, you see. And in the second half of the year, I look forward to being able to stop adjusting for eBay and letting the strength of our core results speak for themselves. So like we said earlier, you know, without the eBay, they're still growing at pretty impressive revenues, and that should stop soon. Our growth ex eBay has consistently been above 20%, and our year-over-year 2-year growth rates have been remarkably stable, again demonstrating the underlying strength of our platform, which is great. And also there's one more here about Venmo, which you've got to remember that PayPal own Venmo as well, which is doing amazing. And also their buy now pay later. So buy now pay later in Q4 alone, a 13 billion run rate with Q4 growth of over 325% year over year. So their buy now pay later is doing very well, massive growth there. And also with PayPal, you've also got to remember you get PayPal and Venmo was very impressive. So Venmo had a solid finish to the year. They had revenue in the fourth quarter up 80% year over year, which is great. And also we are still at the beginning of our monetization journey with Amazon. So you've got to remember that Venmo is now going to be offered on Amazon. You think about if Venmo just even take a slight little cut of every transaction on Amazon. Venmo numbers once again are going to be really, really good. So these are two parts of the businesses as well that I was really impressed with what's growing. So yeah, overall I look at PayPal and go, yeah, the valuation was definitely stretched, but now I look and think this is way undervalued for a company like this. Down at 33 times earnings with the growth it has, Venmo, the buy now pay later, the Amazon deal to come in. I think this is a really good opportunity, and this is PayPal on the metrics point of view. And same again, you look at PayPal from like a historic metrics point of view. Total enterprise to revenues, it's down at a 4. It has never traded at a 4 before in the last kind of 4 years. You got 6 there, 5s until it had a bit of a boom where the share price went a bit mental, 9s, 11s, 10s. But this is massively down from what it normally is at a 6. If you look at the total enterprise value to the EBITDA, same again, it's 17. Same again, the lowest it's ever been is 20, was 20, and that was once again in the correction that we had in December 2018. In the normalized earnings P ratio, down at 25 on a forward basis. Same again, the only time it was that low was in the CV crash, and even then it was 28. So, from the historic valuation point of view now, it's so cheap. And just look at the past performance of this company, the revenue moving in the right direction, profit moving in the right direction. And it's just forecast to do the same with PayPal, with Venmo platform. I think it will continue to do that. So I enjoy picking this one up on this dip. Balance sheet's pretty heavy. It's got quite a decent debt to equity. It does have a bit of cash on, a bit of debt on there, but it has plenty of cash, which is fine. And one little positive that I've got to say is that there has started to be, and you don't normally see this on like a big company like this, but there has started to be a lot of insider buying. So you can see here, like the chairman of the board bought some shares in November, and if we go to February, you can see the CEO actually bought some shares, which is great, and also some couple of members of the board bought some shares as well, which is really positive. To see that kind of backing from some of the management team when it's on this dip is great. So yeah, PayPal, I'm very, very bullish on PayPal right now. To be on this sort of dip, on this valuation, I'm really interested in this one right now. So yeah, this probably won't be the last time that I do buy PayPal while it's down here. I'm quite happy to be buying some shares on this one. So yeah, hope you enjoyed the video anyway, guys. If you could, hit the like button if you're new, subscribe, and I'll catch you all in a bit, and have a good weekend.